Welcome back to The Explainer, everyone. Look, if you're trying to cut through the absolute noise and figure out exactly what is moving the financial world right now, well, you are definitely in the right place. Today, we're breaking down a truly dramatic turnaround that literally just took the Indian stock market by storm. I mean, after days of relentless selling pressure where the screens were just a complete sea of red, Friday brought this explosive surge. But what actually fueled it? Was it real, fundamental strength, or maybe just a mirage? We're going to look at the data, the global context, and the hidden mechanics of the market to uncover the true anatomy of this Friday surge. The market chatter right now perfectly captures the ultimate question we're answering today. Essentially, after days of just brutal falling prices, the market saw tremendous growth on Friday. Both the Sensex and Nifty pulled off a spectacular recovery. But why did it suddenly jump so much? Is this actually the start of a brand new bull run or just a temporary rally? Let's unpack the whole thing. All right, here's our roadmap for today. We'll be hitting the sudden Friday surge, positive global market cues, the mechanics of the short covering rally, and FII and DII buying power. Finally, we'll check out the leading sectors to figure out, is this a sustained bull run or just a temporary bounce? Section 1. This sudden Friday surge. Does the market crash actually end here? Leading up to Friday, the mood was honestly incredibly bleak. Investors were just staring at red candlestick after red candlestick falling rapidly. And the selling pressure, it felt totally relentless. But then, almost out of nowhere, the narrative flips entirely to market crash ends, Sensex and Nifty witness a strong rally. The sheer speed at which the benchmark indices recovered was honestly staggering. We aren't talking about a slow, cautious climb here. It was an aggressive, high-volume sprint right back into the green. Now, markets of this massive size, they don't just turn on a dime like that without some huge underlying forces at play. So what exactly triggered this sudden, violent shift in momentum? Moving on to Section 2, positive global market cues. You see, this domestic turnaround didn't just happen in a vacuum. In our hyper-connected financial world, sentiment is incredibly contagious, and this rally actually started time zones away. US markets turned strongly green, totally shaking off their own recent sluggishness. Then, as the sun rose over Europe, well, their markets rallied too. By the time the Asian indices opened, they were showing undeniable strength. This global wave of positive sentiment acts kind of like a massive safety net. Seeing international markets perform so well gave a huge boost to investor confidence back home, basically signaling to everyone, hey, it might actually be safe to start buying again.
Which brings us to Section 3, the short covering rally. Now, short covering became a massive fuel source for this rally. It's wild, but the very people who were betting against the market actually became the ones driving its fastest gains. Basically, traders who were heavily positioned for a decline got caught out. They were forced to aggressively buy back shares just to close out their bearish positions, which creates this frantic demand spike. Think about it. When thousands of bearish traders are forced to hit the buy button at the exact same time just to stop the bleeding, it creates an artificial frenzy, pushing prices exponentially higher.
And this whole thing accelerated into a classic short squeeze. It goes like this. First, traders bet on a market decline. Then, the initial surprising rise, sparked by those global cues we just talked about, triggers sheer panic among the bears. Finally, they scramble to buy back shares. It transforms what would have been a moderate recovery into a massive vertical rally, as they rush to limit their losses. The momentum literally feeds on itself. The higher the market goes, the more short sellers are forced to cover, which pushes the market higher still. It's a crazy cycle.
All right, Section 4, FII and DII buying power.
For a rally to have real sustainable weight, you absolutely need the institutional heavyweights stepping into the ring, and here we saw dual forces at play. Foreign institutional investors injected serious capital, while domestic institutional investors provided massive underlying support. Now, normally, you might see one group buying while the other is selling, right? Kind of balancing each other out. But on this particular Friday, both foreign and domestic financial giants aligned perfectly as aggressive buyers. This synchronized injection of just massive amounts of capital added incredible fuel to the fire, easily helping key indices blast right through those heavy resistance levels.
Let's look at Section 5, sectors leading the pack.
To really understand the structural integrity of this surge, we've got to track where that institutional money actually flowed. Banking was a massive contributor, which, is totally expected given its heavy weighting in the indices. But IT stocks also saw a huge resurgence, right alongside some really powerful moves in auto and capital goods. When you have these foundational pillars of the economy leading the charge, it gives the rally real weight. We aren't just talking about speculative penny stocks jumping around. These are the absolute heavy hitters of the Indian economy, physically pushing the Nifty and Sensex forward.
Finally, Section 6, Bull Run or Temporary Bounce.
So this is the critical crossroads question that every single investor must answer right now. You look at your portfolio, you look at Friday's green charts, and you have to decide, is this really the beginning of a sustained recovery, like a brand new bull market that you should be buying into right now? Or is this just a temporary bounce? A trap designed to lure in unsuspecting buyers right before the floor falls out again.
The pessimistic scenario here, of course, is what we call a dead cat bounce. The real risk is that this sharp mechanical bounce, which, remember, was driven heavily by that short covering frenzy we discussed, is merely a temporary reprieve that hasn't actually altered the underlying bearish reality. Sharp drops very often trigger brief recoveries without changing the long-term trend at all. Recognizing this risk is absolutely crucial so you don't get faked out by just a single day of green on your screen.
So how do you tell the difference between a real, solid recovery and a dead cat bounce? Well, you follow the data. First, keep a close eye on global developments. Will the US and Asian markets actually sustain their strength? Second, watch the institutional flows. Are those FIIs and DIIs going to continue buying next week? Or was Friday just a one-off fluke? And finally, track upcoming economic data to see if the fundamental health of the economy actually justifies these higher stock prices. Look, don't let a single day's surge dictate your entire investment strategy. Watch the data, monitor these indicators, and ask yourself, is the market actually healing, or is this really just the calm before another storm? Keep learning, stay focused, and I'll catch you in the next explainer.